All right. We have here financial management and advanced financial management. There are two critical topics. If you don't understand very well, you will never pass in these two papers. The foundational topics. So the first one, which is really crucial, is the cost of what here? The cost of capital. Without understanding cost of capital in this or in this, automatically be failing every now and then. So remember, cost of capital falls under what we call what here? The financing decisions. Falls under what we call the financing decisions, like that. Cost of capital stroke financing decisions. Very, very important. Very, very important. So under cost of capital, we must know how do we compute cost of capital. So we have in this case here, for example, cost of equity using dividend valuation model, using dividends. We have cost of equity using CAPM, all right, and many other methods here. Very, very important. We must know how to get cost of preference shares, cost of ETC. So today I would want us to look at a question. This question I've just borrowed it from financial management. And I would want us to tackle this question not tomorrow, but now. Now. All right. So, ladies and gentlemen, what are we told here? All of us will be able to benefit, even if you are doing financial management or advanced financial management. This class is for all of us. It's quite an old question. Old is gold, always. Old is gold. November 2017, question number 3B. This question will expose us a lot to capital structure decisions, to cost of capital questions. Most importantly, this concept of what here? WMCC, weighted marginal cost of capital. So here we are. So you're told Ray Properties Limited is planning to build a business mall. The project will cost 180 million. The firm's current optimal capital structure is as follows. So we have ordinary shares, 10% debentures, we have retained profit, like that. Additional information. The firm will issue a new 15% debenture at shillings 120 each with a flotation cost of shillings 10 per unit. The par value of each debenture is shillings 100. The new ordinary shares will be issued at the current market price of 30 each with a flotation cost of 5 per share. The most recent dividend paid by the company was 5 per share. The dividend is expected to grow at the rate of 5% per annum in perpetuity. The firm expects to retain shillings 18 million to finance this investment. The corporation tax rate is 30%. So they want us to give them the amount to be raised from equity capital if the capital structure is to remain what here? Is to remain unchanged. Is to remain. You see, the capital structure is not going to change even in the future. So when it comes to borrowing this 180 million, when it comes to them borrowing this 180 million, they're going to use their capital structure the way it is. All right. So this is the firm's current optimal capital structure, and it's not going to change. So then the first thing that a good student should be able to do is to give us the optimal capital structure weights. Give us the optimal capital structure weights. Give us the optimal capital structure weights. Optimal capital structure weights. So give us the optimal capital structure weights. So we have here optimal capital structure. Optimal capital structure, what here? Weights like that. So we have two of them. We have equity and then we have debt. We have equity and then we have debt. So equity is how much? Equity I can see because this is future borrowing. I'll be able to explain this better. Equity we can see ordinary shares and we have retained profit. So please add both of them under equity. So we have 480,000 under equity. We have 480,000 plus 96. Because you see, ladies and gentlemen, if you're able to remember equity, the owner's funds. The owner's funds equity, we can raise money from the owners in two ways. Number one, we can sell shares to them. All right. If we sell shares to them, ordinary shares to them, then they give us equity. Remember, equity is money from the owners. Or in this case here, these guys here can say, I mean, you guys made profits of 10 million last year. We are going to leave that money with you. So whenever we talk of equity, we are looking at retained earnings and ordinary shares. And that is why I'm adding these two. So can somebody give me this total here? 480,000 plus 96,000. This will give me what figure? Abracadabra. 480,000 plus 96,000. This will give me what figure? Abracadabra. If you don't talk to me, then so we have here fit2 576,000. Thank you so much. 576,000. Thank you so much. And then we have our debt. Is there somebody who is able to see the debt amount? Oh, yeah. The debt amount, what do we have here? Debt amount. Debt amount, ladies and gentlemen, is 384,000. The debt amount is 384,000. Debt amount is 384,000. So then in this case, are you able to give me this total figure here? Please give me the total here, the total capital structure, the total here. What do we have for the total, ladies and gentlemen? Total is 500 and no, the total when you add the two is 960,000. So this is 960,000. So I want you guys to give me the weights here. Give me the weights here. Give me the weights here. So this will be 576 over 960. This will be 384 over 960. If you wish, you can put those 3 zeros, but I've just chopped them. I've just chopped them. So is there someone who can give me these weights in 2 decimal or even 4? It doesn't matter. Give me 2 decimal places for my, 0.6. Exactly 0.6. Exactly 0.6. So most of them are saying, Mwalimu, this should be 0.6 exactly. Thank you very much. So this is 0.6. Then therefore, this will be 0.4. 0.6. So what does this mean? It means that in future, even in future borrowings, 60% will be equity, 60% will be equity, and the 40% will be debt. Sijui kama tunaelewana hapo kwamba in future, because of this 60%, we have an optimal capital structure. And if it's optimal means best, we don't want to change from an optimal capital structure to a bad capital structure. So come up as 60% will be equity and 40% will be what here? Will be debt. So what is the question asking us to do, ladies and gentlemen? What the question is asking us to do, if you look at the question very well, they want us, number one, to give them the amount to be raised from equity capital, if they're capital. So the amount to be raised from equity capital. These managers, how much do they want to borrow in total? Hey, Ray Properties Limited is planning to build a business mall. The project will cost Kenya shillings 180 million. So out of the 180 million, we know that 60% will be equity. Therefore, equity amount will be 60% of 180 million. So is there somebody who can give us this figure? 60% of 180 million. How much are we getting there, somebody? Because you see, the mall they are planning to construct is 180. So out of this 180, how much should be equity? How much should be debt? So according to Margaret, it is 108 million. Yeah, thank you very much. 108 million. Alafu sasa usianze kujifanya kama ni mjuaji. Wanza kusema ati na amount also from debt. You see, the examiner has not asked you about the debt amount. It is only the equity amount the examiner has asked you to get. It's only the equity amount that the examiner has asked you to get, which is one way. By definition, remember that the optimal capital structure is that capital structure that minimizes WACC. The capital structure that minimizes where WACC is bare minimum, where the cost of capital is minimized. That is what we call the optimal capital structure. We don't want to move from those percentages. No, we'd want to whatever, just out of for understanding. For understanding, Can somebody, so you have told me equity is 108. So then debt will, because in total we want to get 180. So can you kindly take 180 minus 108? Debt will be how much here? 180 minus 108 will be how much? 72. So you see now, even in our future borrowings, if you try to take this 108 divided by 180, this will be 60%. If you take 72 divided by 180, this will be 0.4 or 40%. So it doesn't matter what kind of a project finance you shall be looking at in future. Whichever project finance amount you're going to look at in future, you must always get that project finance in the given what year proportions, because those proportions are optimal. Those proportions are optimal. So is number one clear, ladies and gentlemen? I forgot to mention something that, of course, if you want to join us at RCM College, this is our number here, 0719 525 1000. If you want to join us at RCM College, that's our number. And we, of course, charge quite reasonable amounts for our classes, 4,800 per paper. And then, of course, 4,000 for any retakes. Retakes 4,000. You need, in this case here, too. Yeah, where do you get the 180? Thanks for asking. Where do you get the 180? Remember, Ray Properties Limited is planning to build a business mall. The project will cost how much here? 180 million. So this is the amount you are looking for. You as the finance manager, you've been told, want to do a project, want to do a mall, and the project cost is 180,000, 180 million, So they tell you get outside there and look for that 180. And then, of course, you're going to issue shares of 180, and then, of course, debt of 72. I hope Festus up to there, we are together. How Festus up to there, we are together. All right, and I'm so happy because I can see we are 61. I'm so sure there must be ninjas here who have called their friends, which is really good, Then from there, we go to question number what here 2. They want us to give them the number of ordinary shares the company should issue to raise the desired external equity capital. Number of shares. So how do we get this number of shares? How do we get this number of shares now here? How do we get the number of shares here in the gentlemen pretty fast? So we get number of shares to be issued. This is how we shall get number of shares to be issued. Number of shares to be issued will be equal to the equity amount divided by issue price. Equity amount divided by issue price. But again, remember, this is really a very, very good examiner, because he is telling you that out of this equity amount, by the way, you gave me an equity amount of how much here? You guys gave me an equity amount of 108, isn't it? You gave me equity amount of 108. Is that the case? Equity, 108. But now out of this 108, part of this will be gotten from the farm. Part of this will be coming from retained earnings. And they've been told, ladies and gentlemen, the amount which will come from retained earnings, you are told here. The firm expects to retain 18 million to finance this investment. To finance this investment, we shall retain ourselves from our profits, 18. So meaning that externally, how much are we going to get from external sources? Because 18 is going to come from, how I pray guys were able to see this. Out of the equity 108, remember equity has got two components. We have in this case that amount which will come from internal sources here, 18, and then we have what will come now from outside there as shares. So what is 108 minus 18? I'm being told it's 90. Out of the issue price. So remember, this is 90 million. Do we know, ladies and gentlemen, how much we shall be issuing each share at? When we sell a share like this to come and help us finance this project, how much will be the issue price? Issue price is the same as what here? Selling price. Never work with par value. No, never work with par value here because you're looking at the money to be collected. You're right, Wycliffe here. So remember what they have told us, ladies and gentlemen, in this question. What they have told us in this question. What they have told us in this question is this. Look at note number 2. Of course, this will be new ordinary shares. New ordinary shares will be sold at the current market price of 30 each with a flotation cost of 5. So remember, it is not the total 30, it is not the whole 30 which will be hitting our accounts. Our issue price is always net of any flotation costs. It's always net of any discounts. Issue price should be net of any flotation costs, net of any discounts. So therefore, this will be 30 minus 5. Then how many shares are we going to issue? Remember, NOS stands for number of shares. Number of shares to be issued. Number of shares to be issued. How many shares are we going to issue, my friends? How many shares are we going to issue, my friends? For this particular project. For this particular project. Why many students fail in FM and AFM? It's because they don't take enough time to understand right now this cost of capital, the capital structure decisions. All right. So I'm being told here that we have here 3.6 million shares. So the moment you issue these 3.6 million shares plus the 18, which is retained earnings, then we'll be able to finance your equity amount very, very effectively. Very effectively. Is there anybody who has a question there for this ninja regarding what we are doing? Anybody who has a question there for this ninja regarding what we are doing this evening? We are doing a very, very important subject. Very important subject, and I'm so sure you guys will come, in this case here, thanking me. You will come thanking me, you will come thanking me. So repeat here, all right. So remember, what have we done here? How do we normally get number of shares? To get number of shares, we shall take the number of, or rather the equity amount, divided by the issue price. Remember the equity amount, when we computed the equity amount was 108. But remember, normally equity has got 2 components here. Equity has got 2 components. We have retained earnings, and then we have share capital. Retained earnings and share capital. So the total equity is 108, and retained earnings will be 18. So then how much do we expect to get from the share capital? It will be 108 minus this 18, which gives me this 90. So then this 90 million is from all the shares. So to be able to get number of shares exactly, I need to come and take the amount to be raised from shares, which is 90, divided by our issue cost. And each share is being issued at 30, and then there is a flotation cost of what here? A flotation cost of 5. A flotation cost of 5. Flotation cost of 5. So 30 minus 5, that gives me what here? 25. So then long run, once I'm able to do something on the optimal weights, but I'll be able to get back to there in the next 2 minutes, if you don't mind. I'll be able to get back to that in the next 2 minutes. Otherwise, allow me to finish this before I allow you, those who have understood, to run away. And then I'll be left with somebody who has not understood this. Now, so number 1, 2 done. Now we are doing number 3. So number 3, they want me to give them the firm's weighted marginal cost of capital. WMCC. WMCC. Now you need to know how to differentiate between WACC and WMCC. Is there anybody who knows the difference between the two? Is there anybody who could be knowing the difference between the two? WACC and WMCC. Anybody who could be knowing the difference between the two? WACC and the WMCC. Ladies and gentlemen, remember the WACC. WACC is for existing projects, for existing finance, That's for existing what year? For existing finance. Existing finance or existing project here. Somebody wants to get 𝗹𝗪𝐶𝐶 for RCM, I mean, for whatever projects that we have, I mean. But anytime you want to get, in this case here, like finance for new funds, for new finance or new funds, new projects, then you shall be able to get what we call the weighted marginal cost of capital. Marginal means what? Incremental. Marginal means incremental cost of capital. And why is this cost of capital going to increase? It's because of new projects. It's because of what? New funds. WACC is for existing projects and the WMCC is for new projects here. Not about internal, no. And then again, remember, ladies and gentlemen, if you remember, we shall be doing this quite a lot. This one here normally considers retained earnings. Considers retained earnings. This one here does not consider retained earnings. You're going to see what I mean, ladies and gentlemen. Whenever you are computing weighted marginal cost of capital, the retained earnings are very, very relevant. Retained earnings are very relevant. Allow me to explain something very important here. So, like, for example, in this question, if, for example, they just wanted you to get an appropriate cost of capital without mentioning WACC, an appropriate cost of capital, would you guys have managed to give us this cost of capital to know that it is WMCC they wanted you to compute? Very few finance scholars would have been able to identify a WMCC situation. Very few. That is why very many students fail this paper called Financial Management and Advanced Financial Management. All right. For me, I would have easily identified this a WMCC situation because I can see even the literature. It is in terms of what your future tense. Future tense, Mwalimu, what do you mean? Mwalimu, today you want to teach us about tenses. These tenses could even be better than you, Mwalimu. No. Look at this, ladies and gentlemen. I just want you to see this. Ray Properties Limited is planning to do what? To build. So it's a futuristic activity. It's a futuristic project that we don't have amongst our existing portfolios. The project will cost what here? 180 million. Will cost 180 million. So this is a new project. So it means that automatically if the examiner was to ask me to compute cost of capital, then the most appropriate cost of capital here would have been the incremental one, the WMCC. And then if it is WMCC, then what am I going to do, ladies and gentlemen, pretty fast here? What am I going to do here pretty fast here? So what I will do pretty fast, ladies and gentlemen, because it is WMCC, it is your normal. It is your normal. WMCC and WACC formulas are the same. Because we know, like in this particular case, to get our WMCC, I will take the weight of equity, cost of equity. We have weight of debt, cost of debt, 1 minus T. The same formula would have been applicable if we had that WACC. So the first thing that I need to do is to compute these items here. Come and give us the cost of equity. Give us the cost of equity like that. And because this is WMCC, then I must compute cost of equity retained earnings. And I must compute cost of equity ordinary shares. I must compute cost of equity because it's WMCC, retained earnings becomes relevant. So I must compute cost of equity retained earnings. How do I do this? It's very easy. Could we be having any ninja that knows how to compute cost of equity? Do we have any ninja that could be knowing how to compute cost of equity formula? Remember, the cost of equity is as a result of the dividends we are paying these guys. Yeah, result of dividend. Not CAPM here, no. There's another formula here. There are two of them, Lucy, here. CAPM cannot apply here. Because you see, for you to use CAPM, thanks, Lucy, but you see, for you to use CAPM, you must hear language like risk-free rate of return. You must hear language like expected return of the market portfolio. You must hear some language like CAPM. All those things are not there. So in this case here, CAPM is not applicable here totally. So here, the only way out of me getting this cost of equity retained earnings, I'll use what we call 𝗪𝗪𝗪 formula. 𝗪𝗪𝗪 formula. So it is DO. And the 𝗪𝗪𝗪 will be growing. You guys will be surprised. He was a district professor, remember. Yeah. 1 plus G. All over what here somebody? All over PO. He was also, no, he never became a provincial, but it was to grow a little bit. He can even become a president. We shall overcome. No, I don't talk politics, I don't talk politics at all. I just wanted to give you a model that you guys will be able to remember for long. Cost of equity retained earnings, you take the O into 1 plus G, all over PO, plus what we call G like that. So then remember that this DO stands for the most recent dividends. DO, the current dividends. The current dividends. What we call the DPS. What we call the DPS like that. What we call the DPS. PO stands for, in this case here, the current what here? Price of a share. Price of a share, to be specific, it is market price of a share. Market price of a share. All right. G in this case here stands for what here? G stands for growth rate of dividends. Growth rate of dividends. Growth rate of dividends. So of course I chose a topic that we haven't yet taught, but very, very sensitive. Yeah. Because when I was advertising the class, for sure if you saw my advertisement, this session was to be for students who have ever attempted the exam and failed. But now that all of us are here, with this speed that I'm going with, you guys, everybody will be able to understand. Yeah, and that's why I requested you to write at the back of your books, So then let's walk together in this journey. Is there somebody who is able to see the current dividends? Anybody who is able to see the current dividends, ladies and gentlemen? Thank you so much. Dividend discounting model. I love that, Caroline. That's very good. That's very good. That's very good. So, ladies and gentlemen, what do we have here? We are told here in note number 2, the new ordinary shares will be issued at the current market price of 30. So that 30 stands for what? Is it DO or PO? Is that PO or DO? It's a market price. So that is PO. That is 30 PO. And then you can see here, the most recent dividend paid by, most recent means today, most recent means now, O. The most recent dividend, which is our DO, will be 5. And this dividend will be growing at 5%. At 5%. So now I have everything really to ensure that I get what here? I get cost of equity, retained earnings. So you guys have just told me that DO. You guys have just told me that DO is 5. Into 1 plus G, G is 0.05. G is 0.05, isn't it? Growth rate is 0. You see 5% is the same as 0.05. All right. Divided by PO. Could you kindly remind me what PO is? I may have forgotten. What is our PO? What is our PO? What is our PO? 30. Plus again, growth rate of 0.0. I would want, ladies and gentlemen, to make it very, very clear for everybody. I would want to make this very, very clear for everybody. Whenever it comes to retained earnings, what is retained in the organization, we don't subtract flotation cost. Because I'm so sure somebody may come and say, well, subtract flotation cost. No. Retained earnings is already money in our bank accounts. We are only going to get this money from our bank accounts, 18 million, we invest in our new project. We shall not be sweating to raise money out of our retained earnings. We only incur flotation cost when we want to sell our company's shares. Selling company shares is never an easy thing. You must advertise a lot. You must have an underwriter. But whenever you're getting money from retained earnings, flotation cost is always what here? 0. If I were you, I would have said that flotation cost flotation cost, flotation like this, flotation cost, and retained earnings. Flotation cost and retained earnings equals who? Equals 0. Flotation cost and retained earnings equals 0. Flotation cost and retained earnings equals 0. So let us get all of us our calculators. Let's get all of us our calculators. So if we get our calculators, we are saying 5 times into brackets 1 plus 0.05 close, you say divided by 30 equals first. Whatever I get, I add this independent G plus 0.05. So then this one here, if I say SD, I'm getting 0.025. 0.025, sorry, 0.025. So this is 0.025, 0.022. No, 0.225, which is the same as 22.5 what here percent, which is the same as 22.5%. So, and the cost of equity, I will have to get cost of equity retained earnings, very, very important. And then I must get cost of equity, ordinary shares, cost of equity, ordinary shares, cost of equity, ordinary shares. So I must come here now. Remember, I'm doing this simply because I'm getting WMCC. Otherwise, if it was WACC, I would not have computed cost of equity retained earnings. I would have straight away gotten cost of equity, ordinary what here? Ordinary shares only. But because it is weighted average, or rather weighted marginal cost, the two of them are relevant. So then go ahead and give me the second tick there. And the cost of equity, give me the cost of equity. Give me the cost of equity shares, ordinary shares. Give me the cost of equity. Give me the cost of equity, ordinary shares. Every other thing will remain the same. Every other thing will remain the same, except for the fact that, ladies and gentlemen, to sell shares outside is never easy. You really have to struggle a lot for your shares to be accepted outside here, like Safaricom did during the initial public offering. You must produce a prospectus, you must advertise on the daily newspapers, you must go to Kameme, you must go to all over. People are advertised. It will be very costly. So now here, because it's cost of equity shares, then you're going to introduce flotation cost. So then this one here will be DO, still that remains as 5, 1 plus 0.05 like that, all over PO. Our PO is 30. PO is 30 minus flotation cost. Flotation cost has been given there. Is there somebody who is able to see flotation cost, ladies and gentlemen? Anybody who is able to see our flotation cost in this question? Anybody who is 5? Thank you so much. 5. And then the growth rate still remains at 0.05. The growth rate remains at 0.05. So then you come and take, in this case here, your calculator, you say 5 times 1.05 divided by 25. You say equals, and then you say plus 0.05 equals SD. I'm getting 26%. I'm getting 26%, 0.26, which is the same as what here? 0.26, which is the same as 26%, like 26%. So is this clear, ladies and gentlemen? Because for me to be able to get this WMCC, I must get cost of equity. I must get cost of what here? Debt. So up to here, is it clear? Is it clear up to here? Very clear. Thank you very much. Now then that opens a door for me to go and now discuss what we call cost of debt. Cost of debt. So cost of debt, we have got 2 types of debt instruments. Do you know them? We have got 2 types of debt instruments. Do you know them? 2 types of debt instruments. Do you know them? 2 types of debt instruments. Do you know them? Do you know them? The debt instruments. We have what we call irredeemable debt. And then we have redeemable debt. Irredeemable and redeemable. Redeemable. Those are those debt instruments with a maturity period. We are told that this debt will be reimbursed after, say, 10 years. And then redeemable, these are the normal bank loans, which of course you and I will always know how to roll over. We keep on rolling them over like that. I mean, kakiisha hivi, unaenda unakopa kingine kwa bank. Ako ni redeemable. Kakiisha, unakimbia unakopa kingine kwa bank. Ako ni redeemable. Now, what kind of debt do we have here? The firm will issue a new 15% debenture at 120 each, with a flotation cost of sh10 per unit. The par value of each debenture is shillings what here? Is shillings 100. Is shillings 100. So what type of a debt is this? Is it redeemable? This debt. Is it redeemable, my good students? This debt. Is it redeemable, my good students? If it was a redemption debt, then I would have seen the period of redemption. I would have seen like this thing should be redeemed after say 10 years. So this is irredeemable. And if it is irredeemable, then this is an examiner who is wishing you success. Because if it is irredeemable, what I will do, I will simply come and get my KD. So this is irredeemable. And if it is irredeemable, then my KD is very easy. I will take the interest, divide this by what your market value of bond, minus any flotation cost if there is. And this interest must be after what year? After tax. After tax. The interest there must be after tax. Then the next thing that I will do, I will come here and compute the interest amount. This is very important, it confuses students. So interest amount, I've seen the rate of interest is 15%. So 15% of the par value. 15% of the par value. 15% of the par value. Remember, interest amount, you take the coupon rate times the par value. You take the coupon rate times the par value. So do we have the par value in this question? Do we have the par value in this question? Do we have the par value in this question? So the par value, ladies and gentlemen, we are told that the firm will issue a new 15% debenture at shillings 120. You can see they're issuing new at shillings 1. That must be the value of the bond. The current market value of the bond is 120, with a flotation cost of 10 per unit, and the par value is 100. So it should be 15% of 100. 15% of 100. So this shall be 15% of 100. So 15% of 100. So 15% of 100. This gives me 15 bob. So it should be 15%, not of the market value, but of the par value. Then my KP, my good students here, will be the interest is 15 shillings into 0.7 all over 120. I'm so sure most of them have not yet seen where I've gotten 0.7 from. Why not 10%? Why not 10%? I like your questions. Why not 10%? If you have just not read. Why not? You can see, remember, thank you for that question. You see, this 10% is the old debt. 10% is the old debt. What are we looking at? We're looking at new finances. We're looking at new finances because we want to build a new project there. And in this new finance, we are told the firm will issue what here? A new 15% debenture. I hope you are together there. Thank you for asking the question. Thank you for asking the question. So then I pick up my calculator. I say 15 times 0.7 divided by 120. Whatever I get, I say times 100. Then, ladies and gentlemen, I'm at home. I'm at home. What are you guys able to get? Caroline, I don't know how you're getting 9.5 through because I'm getting 8.75. 8.75. Yeah. Remember, tax rate has been given as 30%. Tax rate is given the question as 30%. All right. So I should say 1 minus 0.3, which is 0.7. And then I say 15 times 0.7. Whatever I get, I'm getting 8.75. Can you kindly confirm? Most of them are getting? Yeah, we have a flotation cost. That is something I would have almost missed out. Thank you for that. We have a flotation cost of 10. Thank you so much. We have a flotation cost of 10. Thank you so much. So we come and take 15 times 0.7 divided by 110. Times 100. Thank you so much. Now we are getting what here? Sample 9.55%. 9.55%. Is that now okay? Are we now together? Are we now together 9.55%? Are we together? 9.55%. Are we together there? Yeah. And fortunately, here we don't have any preferential capital. In our capital structure, there's nothing like preferential capital. So now we are through with this cost of capital. We are through with the cost of capital. Now, there is one thing that I will need you guys to tell me. I also have the weights. But if it is WMCC, I need what we call the breakpoints. If it is WMCC, for WMCC, you must always compute breakpoints. For WMCC, you must compute breakpoints. You must compute breakpoints. If you remember very well, a breakpoint is that exact point where the cost of capital changes. That exact point where the cost of capital changes is what we call breakpoint. That, for example, your cost has been 12. Once you hit this breakpoint, then of course we expect the 12 to go up, maybe to 14. So the breakpoint, of course, is there to get rid of what are these continuity. So at the breakpoint, for WMCC, you must compute breakpoints. And at breakpoint, we expect the cost of capital of a firm to change. And how do we get these breakpoints? To get breakpoints, ladies and gentlemen, this is how we normally get our breakpoints. Very easy. To get breakpoints, we normally take the maximum amount. We normally take the maximum amount available over the weight in the capital structure. This is a very important formula that I want you to write. And once you write it down, could you maximum amount available divided by weight in the capital structure. And we shall get the breakpoint for equity, and for debt. So remember, equity, you've got two things. You have retained earnings and you have ordinary shares. So equity, you must give us a breakpoint for retained earnings first, cheaper, and then breakpoint for the ordinary shares. So come here and they give me BP1, retained earnings. Let me ask you guys a question. Has this examiner given me the maximum retained earnings? For this particular project, have they given me the maximum retained earnings? Do I know how much can I withdraw maximally from the retained earnings account for this project, for this new project? They have told me they're going to give me how much maximum? They're going to give me 18 million. 18 million. All of it, if it is, I would have actually written like this. So this breakpoint, it will be maximum amount available, divide this by weight of equity. Because you see, retained earnings is an equity component. And you're saying that for retained earnings, we have 18 million. So this 18 million, we divide this by the weight of equity in the capital structure. Is there someone who can remind us what the weight of equity in the capital structure, the optimal capital structure, the weight was it 0.4 or 0.6? Can someone remind me this? And this is going to be very clear, by the way. Can someone remind me this? So the optimal weight was 0. What here? The optimal weight was 0.6. The optimal weight was 0.6. So can you kindly go ahead and divide this for me? 18 million divided by 0.6 will end up giving me what breakpoint? We are almost finishing. Just 5 minutes, we finish. 5 minutes, we finish. So this is giving me 30 million. Thank you so much. Then we shall come and get breakpoint 2 for ordinary shares. Breakpoint 2 for ordinary shares. Breakpoint 2 under equity, we have retained earnings and ordinary shares. So we ask ourselves, we go to ordinary shares. Let's go to ordinary shares. What are they telling us under ordinary shares? 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 They're only telling us new ordinary shares will be issued at current market price of 30 each. They are not giving us any maximum. There is nowhere they're defining maximum amount that we can get from ordinary shares. They're not giving us any maximum. So like some video I watched some time back, they used to tell us no retreat, no surrender. No retreat, no surrender. So the same case here. So here, because you don't have maximum, you will simply tell us no maximum, and therefore no what here, no breakpoint. No maximum, and therefore no breakpoint. Please write up to here. I know these are a little bit heavy, but you will like these ones that do the second example. Nevertheless, feel free to ask questions. But I'm 100% sure but that by the time I'm doing the second example, all of us will be very comfortable with this. All of us will be very comfortable with this. All of us will be very comfortable with this. All right. So that is breakpoint for equity. Go ahead and give me breakpoint. Go ahead and give me breakpoint for debt. Breakpoint for debt. Give me breakpoint for debt. Go ahead and then you give me what we call breakpoint for debt. So go ahead and give me breakpoint for whom? For debt. So remember the breakpoint for debt here, this will be maximum debt amount, which is specified, which must be specified in the question. Maximum debt amount, which must be specified in the question, divided by weight of who? Divided by weight of debt. Ladies and gentlemen, even if you are to go all the way from here to Timbuktu, in terms of debt, there is nowhere they are specifying any amount. There is nowhere they are specifying any amount. Nowhere. Nowhere. If you look at debt, just try reading this debt, new information. The new information on debt, there is nowhere they are specifying. I'm telling you the truth. There is nowhere. You'll see here. You will see here. If you come to that, you will see here. The firm will issue new 15% debentures at 120 with a flotation cost of 10 fine. The par value, there is nowhere they are talking about like 100 million is the maximum you can get from debt. There's no restrictions here. Remember, breakpoints normally happen whenever there are restrictions. So here there are no restrictions at all. No restrictions at all. So in this case here, then what do we do? No maximum. As somebody is telling us there globally. So also for breakpoint for debt here, no maximum, and therefore no breakpoint, no maximum, and therefore there's no breakpoint. So then go ahead and now give us summary. A summary is very, very important. Now we have finished the question. Just go ahead and give us the summary. Go ahead and give us the summary. We have now finished this question. Give us the summary. So the summary, I would want us to look at equity. So remember, for equity, I have in this case here cost of equity 1. Is there somebody who can remind Mwalimu what cost of equity 1 was? Was it 22.5, the one of retained earnings? Was it 22.5%, the one of retained earnings? And then the cost of equity 2. Cost of equity 2 was 26%. Is there somebody who is able to remember this? Is there somebody who is able to remember this? Yes. And then don't forget that we had a break point, just one break point of 30 million. One break point of 30 million. That is equity components. That is equity components. Very, very important. I have the two costs of equity, and then I have one break point like that. Very important. This is very important to me. This summary is very important to me. Ladies and gentlemen, I would want you to right away go ahead and give us the summary of that. That, if I remember very well, KD was only 1. The cost of debt was only 1. Was it 9.26? KD was only 1 without a break point. KD was only 1 without a break point. 9.55, yes. This was only 1. 9.55 like that. So go ahead and give us the WMCC schedule. Go ahead and give us the WMCC schedule. WMCC schedule. I'm so sure when I teach this for the very first time, there are ninjas who will just feel like energy has ran away out of their bodies. Even their breath has ran away out of their lives. But trust you me, once I repeat this or I do a different question, now ninjas will come back to life. So just hold on to your breath. So weighted marginal cost of capital schedule. So you shall give us breakpoints in ascending order. Breakpoints in ascending order. Fortunately, we only have one, which is 30 million. Only one, 30 million. We only have one, which is 30 million. So from there, come and give us, in this case here, the finance range. Give us what we call the finance range. So the finance range, you have to be very careful. You talk of 0 up to the figure we have here, 30. 0 up to 30. And then you say over 30. Over 30 up to. Remember, your finance range must go to infinity. So many guys forget the second class. The first one is 0 up to 30. The second one now is above 30 up to infinity, like that. You allow me to move quite fast in this, and then I'll be able to come and take care of the ninjas who will not be able to see what I'm doing. So then I'll come and write here cost of equity. I post cost of equity. I want to post cost of equity here. Remember, the first cost of equity, which is 22.5%, runs up to the first breakpoint. This 22.5 will be applicable up to 30 million. So it means up to 30 million, it will be 22.5. Beyond that, we take a new cost of equity. And the new cost of equity will be what here? 26. Above this 30, we take 26 like that percent. I know that's Greek, but I'm not afraid because I know everybody will understand. How about KD? KD ni telezi. KD haina break. KD does not have any break point. KD is 9.55. 9.55%. KD does not have any break like that. So is there somebody who is able to remember what the weight of equity was? It was 0.6. And the weight of debt in this case here was 0.4. So now you can comfortably give me the WMCC. You can comfortably give me the WMCC for each financing range. WMCC for each financing range. So this one here, ladies and gentlemen, we know the formula of WMCC. Yeah, I'll be able to address those questions if you don't mind. I'll be able to address those questions if you don't mind. So our WMCC, ladies and gentlemen, will be weight of equity, cost of equity, plus weight of debt, cost of debt. Of course, we have already adjusted this for tax. So abracadabra kama ya kwanza oye, unachukua weight which is 0.6 times 22.5% plus 0.4 times, in this case here, 9.55%. Already remember this figure is tax adjusted. That KD is already tax adjusted. So can somebody give me that answer before I start repeating? Can somebody give me this answer before I start repeating? How do you get the 9.55? I'll come back to that. So before I start repeating, can somebody give me this answer here? Somebody give me this answer here before I start repeating here. So this gives me 17.32%, 17.32%. And then we have the last one here. This will be, you know, it's this 26 times 0.6. So 0.6 times 26%. Plus, in this case here, 0.4 times 9.55%. Is there somebody who is able to give me this figure? 0.6 times 26% plus 0.4 times 9.55%. So this one is going to give us the final figure there. Somebody should be able to give us an answer. The final figure there will give us 19.42%. So this gives us 19.42%. And now that marks the end of that question. So this question has got various concepts of a cost of capital, which really are very important. So tomorrow, I'll be able to do the same question, a similar question, all right, just one. And then in that topic, we'll never ever now touch that topic again. So there are various questions that have been asked there, which I would prefer, if I can give you this video, I'll be able to attach this video on my YouTube channel. On my YouTube channel, yeah, because it's a marketing video, and by the way, I would want to welcome all of you to RCM College. Come and study with us. This is our number here, 0719525000. And right now we have partnered with the HELB for our students to get the HELB loans. Like the ones who applied, you know, at first we were not believing with we were not believing that information. So just took some, about 20 students through, they were able to apply. They got allocations. Some of them were getting allocations of up to 60,000 at RCM. And is this 60,000 at RCM, given that we charge 4,800, all right? That will give you money for how many semesters? 4 semesters. And the other good thing with the HELB, ladies and gentlemen, is the fact that that loan, you'll only start repaying that loan after 3 years. After 3 years. And it is at 6%. Who will ever give you a loan at 6%? 6%. All right. So if you would want, in this case, to get information about the HELB, and whatever, this is the person, the manager in charge of HELB at RCM. Yeah. They'll be able to take you through the process of applications, which is very important. Yeah. And remember, when you are doing CPA at the moment, yeah, you can apply. If you have a brother at home, a sister at home, who has a interest in accountancy and maybe you've been lacking funds, this is the opportunity, because CASNEB pays for them even registration fees. I mean, CASNEB now has really styled up. It's CASNEB and HELB. Yeah. So in this case, you are paid for. And remember now, this loan is not like the university loan, which has got a lot of this one does not have competition. Actually, this is the first time people are getting these monies. All right. So it doesn't have no much competition. Whatever you apply for, maybe it will not come up 5,000. You apply for 6 to pay 50, 55 like that. Ukipata hiyo, ukimaliza hiyo semester ama mwaka ikisha, you apply more like that. All right. So then that was just by the way, the most important thing. We are ready to teach you finance, and we are welcome to join us at RCM. Otherwise, for now, please work with the video that I shall be able to upload on my YouTube channel, which is Joshua Aura. This video, very important, and be able to know how to call it. So Joshua Aura, and once you go to Joshua Aura, ensure that you are subscribing. Ensure that you are subscribing. Yeah. Are you able to tag me? Are you able to tag me, Purity? Are you able to tag me on the group there? Nowadays, you have young men who are able to really give students access to LMS very fast. Very fast. Otherwise, thank you so much. Be blessed. Enjoy your evening. Yeah, immediately, Gloria, after this, yes. After this, I'm taking it up now. Give me maximum 20 minutes. Thank you. Bye. And let's make RCM a household name on matters of what year? On matters of accountancy in this industry. Thank you. Bye.